Hi, this is Alan Gassman of Gassman Law Associates, and I'm very pleased to welcome all of you who are on this live webinar with a personal hero, Jim Feutz, who is a fantastic, creative actuary. Jim does a great job with pension plan design and has taught me so much. And I wanted to sit down with Jim and just get a good 50-minute lesson on sort of a comprehensive, basic summary of the types of good planning practices we can put together for clients with pension plans. So Jim, welcome.
Well, thank you, Alan. I appreciate the opportunity to be on the webinar, and welcome to all the attendees. First off, of course, you have to have the normal disclaimers. This webinar is for educational purposes only, so any tax advice you can't rely on. The opinions are my opinions, not necessarily those of my employer or anyone else. And then I am a member of the American Academy of Actuaries and meet their qualification standards to present the information we're going to cover. Now, please feel free to ask any questions you have during the webinar by typing them in the question box on the GoToWebinar dialog box and then clicking the Send Privately button. I'll try to address these as they come up, or there should be enough time at the end of the presentation to ask any additional questions you have. Now, what are we going to cover on today's webinar? Well, first we'll talk about the retirement plan limits for 2013. Several of them have changed, some have not. Then we'll talk about 412I plans. It's a type of defined benefit plan that was popular several years ago because of the large deductions that could be generated, but they've had some problems. Then we'll discuss multiple employer plans. These plans are becoming more and more prevalent to help try to reduce some of the costs of the administration of plans. Next, one of the hot topics on the Department of Labor hit list is delinquent 401k contributions. When employers don't deposit their deferrals on time, it can cause all sorts of problems. Then we'll discuss some of the proposed changes to retirement plans. As you know, tax reform is on the forefront of the burner right now, and there's going to be a lot of proposals coming down. Some of them will be good for retirement plans, some of them won't be. So we'll discuss some of those. Next, we'll talk about the flexible 401k safe harbor plans that can work very well for small employers to optimize the benefits for the owners. And then we'll give a few examples for planning opportunities for 2013. And in fact, it's not too late in certain circumstances to set up a plan for 2012 if that would help a client. Finally, time permitting, we'll talk about some of the current problems that have come up in the last few months with regard to retirement plans that you need to be aware of. So first, the limits for 2013. Well, the compensation limit, that's the most compensation you can take into account for retirement plan purposes for discrimination testing and contribution calculations, is increased from $250,000 in 2012 to $255,000 in 2013. The maximum 401k deferral is going up by $500 to $17,500 in 2013. The catch-up contribution, however, remains the same at $5,500, and that only applies to those participants who are at least age 50. The maximum overall contribution in a defined benefit plan goes up $1,000 to $51,000. Now, for a participant age 50 or more, they can get an additional catch-up, so their maximum would be $56,500 next year. Now, one of the important determinations when you do non-discrimination testing is who is a highly compensated employee. Well, any person who owns more than 5% of the owner, either in the current year or the prior year, is automatically highly compensated for the current year. In addition, based on the pay of the other employees, anybody who makes over a certain limit in the prior year is highly compensated for the current year. So the limit is going to stay the same at $115,000. So that means anybody that makes over $115,000 in 2012 will be highly compensated in 2013, and likewise, anybody who makes over $115,000 in 2013 will be highly compensated for 2014. Now, there is one option that an employer can choose. If you have a lot of high-paid employees, such as a law firm or a technology firm, you can limit the number of people who are counted as highly compensated to 20%. Of course, anybody who owns over the 5% would be highly compensated regardless. The maximum defined benefit that's allowable increases from $205,000 to $205,000 from the current $200,000. Now, this is the maximum benefit at age 62 and also at 63, 64, and 65. If a participant retires after 65, the maximum benefit increases for actuarial adjustments as the participant gets older when they first start taking their benefit. However, it's not increased above the compensation limit, which is $255,000. In a simple IRA, the maximum deferral increases $500 to $12,000, but the catch-up there again remains the same at $2,500. And the Social Security tax base in 2013 will be $113,700, which is up somewhat from 2012. Now, let's talk about 412I plans. Well, first off, they aren't 412I plans anymore because they changed the tax code section. They're now Section 412E3. And these are plans which are defined benefit plans which are funded exclusively by individual insurance contracts. If there's any other investments, then it disqualifies the plan as being a 412E3. It still can be a viable defined benefit, but you can't rely on the 412E3 regulations and rules. One of the rules is that no policy loans are allowed in the plan. So if somebody were to borrow from one of the insurance or annuity products, it would immediately disqualify it as a 412E3, and it would become a regular defined benefit plan and would be subject to the minimum funding rules, because a 412I plan, now the 412E3, is not subject to the minimum funding rules. However, of course, the retirement premiums for the insurance and the annuities still must be made. So in effect, it does have a required contribution. It's just not the technical minimum required under the funding rules. In addition, the 412E3 plan does not have to file a Schedule B, which is the actuarial attachment that must be attached to a regular defined benefit plan. Well, over the last several years, the IRS has been auditing many of these plans, and they've found several problems. One is that some of these plans had way too much insurance based on the limits that the code imposes. Another one was they found what are called spring and cash value plans. And what this is an example. Let's say you had an insurance policy where the contribution needed for the owner for the insurance premium was $200,000 a year. So after 5 years of holding this policy, the employer would have paid $1 million for this policy. Many times the participants buy the policies from the plan to keep them personally for different reasons, and let's say the insurance company sort of winked their eye and pretended that the cash value after 5 years, it's only $200,000, even though they paid $1 million. And then all of a sudden, a couple years later, it magically increases by springing up to maybe $800,000 or $900,000. Well, that's, besides being fraudulent, the IRS definitely didn't like it and thought that would be a listed transaction. So anybody who had those type of policies in their 412I plan, if they got audited, they were in very deep trouble and paid a lot of penalties. As far as I know, that the insurance companies have tried to stay away from the spring and cash value plans recently, at least. There's also discrimination issues. If you have any staff participants that must be covered because they meet the eligibility rules, it's difficult to design a plan that will not be discriminatory and still have a reasonable cost, because the policies have to be the same for all the participants, and that can be very expensive. Whereas if you design a different type of plan that we'll talk about later, you can keep the staff cost to a reasonable level. So I guess the net, in summary, the 412I and now called 412E3 plans are definitely on the IRS radar screen, and if a client sets one of those up, just tell them to count on being audited.
Jim, can the 412E plan own annuity contracts, or it has to be life insurance?
No, it can be, they can own either all annuity contracts or all life insurance.
But not some of life insurance, some annuity?
Some have done that, but I think you have a potential non-discrimination problem, especially if you give annuity contracts to the staff and life insurance to the owners.
Right. So these rules are streamlined for purposes of drafting, but very cumbersome for purposes of not having investment choices, correct?
Well, that's true, and the main people that benefit from these are the people who sell the insurance.
Right.
Not the employer.
Very good.
Let's talk about multiple employer plans. Well, first, what is a multiple employer plan? Well, traditionally, a multiple employer plan has been a plan sponsored by like an association, like the American Bar Association or the American Dental Association. They sponsor a plan, and then their members can adopt the plan, which cuts down the cost of administration because it's usually a plain vanilla plan, and they can adopt it with different eligibility and a few other provisions, but for the most part, everybody has the same type of plan. So those have been around for many, many years. But recently, in the last few years, plans called open MEPs have arisen. And what that is, it's a multiple employer plan where a given employer sets up a plan, and the only purpose of the employer may be to have a plan, and then they allow other employers to adopt the plan regardless of whether their business is related or not. In other words, it's open to everybody. So some of the advantages, at least before the Department of Labor came out with recent guidance, was that it would reduce the cost of a CPA plan audit. Because if a plan has over 100 participants, you have to have a CPA do an audit of the plan, whereas if you have a MEP, all these assets are in one place, and the CPA supposedly would only have to do one audit, which would decrease the cost. It would also reduce the fiduciary risk, because the employer that sponsored the MEP would be responsible for selecting the investments and the people and funds providing those investments. The employer would still have the fiduciary risk for selecting the MEP, but it would be less of a fiduciary risk than normal on a plan. Another advantage was to be that you only have to file one annual report. So that would be a cost savings, because if you had 150 employers that adopted this MEP, you'd only have one annual report instead of 150. And the same thing with the ERISA bond. You'd only have to have one bond for the entire plan, and you could probably get a better rate than having 150 different ERISA bonds. Well, the DOL recently came out with guidance because one of the open MEPs had requested determination on whether the way they were operating their open MEP, which was available to anybody, whether it met the Department of Labor rules. Well, the Department of Labor said if the employers are related, like through the association, like the ABA, that was fine. You would have all the advantages that we list there on the screen. However, if it's open to anybody, any employer, then the annual report must be filed for each plan each year. In addition, each plan would have to have an ERISA bond. So you would still have some savings, because the employer, when you have 150 employers going to get an ERISA bond, it can be streamlined quite a bit at a lesser cost. In addition, a separate CPA audit would be needed for each of the adopting employers that have over 150 participants. Now, many of them would have under 100 participants, and they wouldn't have needed an ERISA audit anyway, so they won't need it, just the employers with over 100. So there still can be some cost savings. However, there's a couple potential problems. One, these open MEPs have been around for a few years now, and until the DOL guidance was issued this year, not too much before the due date for the 2011 5500 returns, they may come back and say, well, for those past years, those 150 employers should have all filed a Form 5500, so we're going to assess late filing penalties. Now, I doubt that they'll do that because there's several ERISA attorneys out there that say the Department of Labor is wrong in their determination that separate annual reports will be filed. So I would assume that they'll do this prospectively, but there's no guarantee of that. In addition, there's one problem from an IRS standpoint is that if there's even one employer out of that whole 150 that have adopted the open MEP that messes up and does something that would disqualify the plan, like maybe not making a safe harbor contribution when they're supposed to, or not making a top-heavy minimum contribution when they're supposed to, or a whole host of other things. Under the current law, that could disqualify the entire MEP, which would cause havoc on the tax deductions that have already been taken. Now, I don't think the IRS would actually do that. I think they would be somewhat lenient, but there's no guarantee of that. However, as we'll talk about in a few minutes, one of the proposals would help solve this potential problem. Now, the depositing of 401k deferrals, if they're delinquent, that's high on the Department of Labor hit list. And the problem arises because the way the law is written, or the Department of Labor regulations, it says that 401k contributions and loan payments that are withheld from a paycheck have to be deposited timely. And by timely, the regs say, as soon as the assets can be segregated from the assets investments of the company, but no later than the 15th day of the business, following of the 15th day of the next month. Well, unfortunately, many people just saw the last half of that sentence and said, oh, you have until the middle of the next month to make your deferrals. Well, that's not true, because the Department of Labor says only in very, very, very unusual circumstances should it take that long. And in fact, they say you should be able to make your deferrals about the same time as you make your withholding tax deposits. So for small plans, the IRS came out and said, okay, we're going to give you a safe harbor. Small plans are those with under 100 participants. If you get the contribution into the plan, the 401k deferrals and the loan payments, within 7 business days, that will satisfy the ruling. For big plans, that doesn't solve the problem. So we recommend to all our clients that they make their 401k deferral deposits and loan payment deposits as soon as possible after the pay period. Now, one of the problems if you have late payments, well, first, you have to report them on Form 5500. So right there, that's an audit trigger when it shows up on 5500 that you made, maybe a couple $1,000s of delinquent deposits. Second, you have to make up the earnings that those deposits would have earned if they'd have been put into the plan timely. Often this isn't very much. If you're late, let's say a couple of weeks, the earnings on that is very, very small, but it still has to be calculated. And the Department of Labor does have an online calculator that can be used in many instances. Then you have to file Form 5330 with the IRS to say, first, we made a mistake, we didn't deposit it on time, we've corrected it, and give the date of correction, and then pay an excise tax, which is 15% of the late earnings. Now, if somebody was really delinquent, and if they were using the 401k deferrals to actually run their business because they had cash flow problems, then the employer and the key people in that company could have criminal penalties assessed against them, and in really severe cases, the Department of Labor has done that. So that's very important to get these deferrals deposited on time. And another reason is the cost to calculate the lost earnings, usually exceeds the amount of the earnings that you have to contribute by a substantial amount. In other words, the cost of the correction is much more than the correction itself. So please remind clients to timely deposit their 401k deferrals and their loan payments. Now let's get into some of the proposed changes to the retirement plans. One of the bills that has been proposed in the last couple of years is the Small Business Pension Promotion Act. This would allow Treasury, first off, to provide relief for minimum required distributions if there's a crash in the market. In other words, if there's a big decrease in investment assets held by defined contribution plans and IRAs. This was similar to the law that was passed that allowed people to forego their minimum required distributions in 2009. But this would allow Treasury to do it rather than having to pass a law to do it. One other nice thing it would do, it would repeal the 10% excise tax on non-deductible contributions. That doesn't mean that those contributions would still be deductible. It's just you wouldn't have the penalty. Another thing that's been a pain in the neck for a lot of ERISA attorneys and sponsors is the interim amendment process. Seems like Congress changes the pension rules one way or another every year or two, and there's regulations that also change how you have to draft your plan documents. So IRS makes you do interim amendments. Well, this law would make the interim amendment process more flexible and hopefully reduce the plan sponsor burden. IRS is also working on this, so hopefully between the two, it will lessen the cost of doing the interim amendments. And then finally, it would make a technical change in the calculation of the funded status of defined benefit plans. And the reason this is important is because if a plan is underfunded by a certain amount, then benefit payments to the rank and file employees as well as the high-paid employees have to be curtailed to a certain extent, and if it's real underfunded, they have to be totally stopped. Well, the way the calculation is done now, it sort of penalizes you for trying to make extra contributions and getting a credit balance. So this would solve that problem. The next bill that we'll talk about is the Retirement Plan Simplification and Enhancement Act. Of course, whenever there's simplification in the title, you've got to worry that what's this going to do to complicate everything, because no bill that Congress passed that has simplify in it, I think, has ever been simple. Well, the first thing, this does have some good provisions in it, but the first thing would say that if you're taking minimum required distributions because you're over 70.5 and your balance drops below 100,000 in all your plans together, both defined benefit, IRAs, and 401k and profit sharing, then you don't have to take any more minimum distributions. So that would be nice. That way, a person, when it gets down to 100,000, could slow down how much they take out, so it'll last longer. However, if your balance increases because of additional contributions or benefit accruals, then you'd have to start taking distributions again until it again dropped below 100,000. One other nice provision of this is that IRS has a correction program where you can, if you make a mistake in administering a plan or in the operation of the plan, you can fix it through their correction program. Many things can be self-corrected. Well, a couple of the things that currently can't be self-corrected they would allow them to be self-corrected. Like if you make an error on a plan loan, you have to apply to IRS under the voluntary compliance program, which can run a couple thousand just to prepare the documents and everything. Whereas if this passes, you'll be able to correct it without going through that procedure. The same thing with and an inadvertent error in making a required minimum distribution, if it's not made timely, technically the excise tax can be 50% of the amount that should have been paid out. Under the proposal, if it's corrected within 180 days, there would be no penalty, and you would not have to file through the voluntary compliance program. Another big thing is it would allow forfeitures in the profit-sharing plan to be used to fund safe harbor contributions. Under the current IRS interpretation of the law, which many ERISA commentators and attorneys don't agree with, IRS has said if you have a 401k safe harbor plan, the safe harbor contributions have to be funded each year, and you can't use forfeitures to fund them. This would solve that and do away with the IRS interpretation of the law, which many people think is incorrect. Another good benefit of this law, well, from some people's vantage point at least, would be to allow part-time employees to be eligible to make 401k deferrals. Currently, you can have a one-year eligibility and say that people have to work at least 1,000 hours in that year to be eligible for a 401k plan. This would reduce the requirement to 500 hours. However, because they don't want to increase the cost to the employer, they've said that you don't have to make top-heavy minimum contributions or matching contributions to these people who meet the 500-hour but not the 1,000-hour if you don't want to. Of course, you could, but you wouldn't be required to. Next, it would eliminate the rule for MEPs that we talked about where one bad plan disqualifies the entire arrangement. So that would be another good provision from this. And then finally, if the employer has never had a plan and they start up a new plan, there's a startup credit that they can get, and they've increased that, or they would increase it from $500 to $1,500. Well, so far we've talked about the proposals that would be beneficial to most plans and most employers. Now the one that would not be beneficial would be what was proposed by the Simpson-Bowles National Commission on Fiscal Responsibility. They came out with a provision because they wanted to get more taxes. Well, there's a couple ways to get taxes. One, you increase the rates. Two, you take away the deductions. Well, they would do it by doing both, but as far as retirement plans are concerned, they would limit the contribution for a plan participant, in a 401k plan to the lesser of $20,000 or 20% of compensation. The limit is currently, for 2012, the lesser of $50,000 or 100%. So this is a huge, huge decrease. And this, of course, would greatly reduce the benefits to the owners. It might not affect the staff so much as far as the amount they can contribute, because many staff couldn't afford to put in 20% of pay or $20,000. However, if it greatly reduces the benefits to the owners and the key employees, many employers would just terminate their plans. And after terminating their plans, many of the owners would just take a bonus of the amount that they would have put in for the employees to the retirement plan, and the real losers are the rank and file employees, which of course none of the people in the government ever think that's going to happen, but that's exactly what happens. And that's what happened in 1982 through 84 when they passed some of their so-called bills that cut the limits way back. Plans were terminated in droves. And it'll even put more strain on Social Security and welfare programs in the future if the employees lose their 401k plans. And the unfortunate part about this is the way that the government, by law, has to score different bills. They only use a 10-year horizon. So they only look at the effect of tax expenditures in the next 10 years. For a retirement plan, granted, the employer gets a deduction today, but when employees and the employer, the owner, start taking out their benefits, they pay taxes in the future. And the tax bills don't take that into account. Whereas in a mortgage deduction, it's a pure deduction, and you never have to lose that deduction. Same way with charitable contributions. So if they would score these using more of an actuarial method of present values, it would lessen, it would decrease the tax expenditure by over half. So because of this, the American Society of Pension Actuaries and Professionals has started a campaign to tell Congress to keep their hands off retirement plan savings. So if you agree that Congress should stay away from 401k plans, you can go to the website there, savemy401k.com, and email Congress telling them to stay away from your 401k plan. The website is pretty easy to do, and you really don't have to do much thinking to do that. Now,
Jim,
let's talk about some design issues.
Jim, before you go to design issues,
yeah.
If there were one or two things that you thought were probable to change in the pension law as Congress addresses the fiscal cliff, does anything come to mind, or is it likely to be no change?
Some form of the Simpson-Bowles Act. Hopefully they won't cut it all the way to 20,000 and 20%, but they could greatly cut it. Like I mentioned, in the early 80s, they cut the limits back about 70%.
Wow.
So it's too soon to tell because they're trying to get money everywhere they can, and it remains to be seen what's going to happen from this. So anybody that would like to save the 401k and the defined benefit plans should go to savemy401k.com and recommend to your clients to go to there and email their Congress people.
Is there likely to be anything grandfathered that should be put into place this year?
Yeah, they'll grandfather the 2012 contributions, but probably not. It depends when it gets passed. If they do it in 2013, it could be effective right away.
Yeah.
Now they would in a defined benefit plan if they cut back the defined benefit limits. They've always grandfathered the benefit you've accrued to date. The trouble with that is, in some defined benefit plans, you may have pre-funded part of the benefit so you don't run into underfunding problems. And then if you have an overfunding and you can't increase your benefit anymore, then you're stuck because they have a 50% excise tax on any excess assets that are left after a plan terminates. I mean, there's other ways to potentially handle that, but that could be a problem for many employers.
Okay, very interesting.
Yeah, it'll be interesting to see what happens. Well, let's talk about the 401k, the flexible 401k safe harbor plans. First off, many plans use safe harbor plans because that allows them to avoid the 401k non-discrimination testing, because otherwise the owners wouldn't be able to make the maximum deferral, which at least this year is $17,000 or $22,500 if you're at least age 50. Well, there's two types of safe harbor plans. One is a match safe harbor where the employer agrees to match 100% of the first 3% of pay that an employee puts in and 50% of the next 2% of deferrals. Now, in this type of safe harbor plan, the safe harbor contribution is only made to participants who make the 401k deferrals. The other type of safe harbor is to contribute 3% of compensation for all eligible participants. Now, the one thing about these safe harbor plans, this is the trade-off to allow the employer not to have to do the non-discrimination test. They must be 100% vested, and there can be no allocation conditions. In a regular profit-sharing contribution, often the employer might say that you have to be employed on the last day of the year, or you have to have 1,000 hours to get a contribution. For this, the safe harbor contributions, you can have no allocation conditions. Well, there's a little used but very flexible provisions that can be added to the 3% safe harbor plan that I think should be more in use. One, you can specify that safe harbor contributions are only made to the non-highly compensated participants. And that's why the definition of highly compensated is so important. And this is very useful if the employer has high-paid non-owners. As an example, a few years ago we took over the administration of a plan that made the 3% contribution to all the participants, and they had 2 high-paid employees that terminated during the year. They had $200,000 of compensation each at the time they terminated, so they each had to get a contribution of $6,000 of their pay, $6,000 for that year, even though they terminated. Whereas if they'd have used this special provision, they would have got nothing at all. Now, you might say, well, the owner loses out too. Well, not really, because when you set up the plan, you can make a 3% profit-sharing plan contribution or even more to the owner, so they really don't lose out, and it makes it very flexible. The other provision of the flexible safe harbor plan is that you can set it up so the 3% safe harbor can actually be discretionary each year. Now, the match contribution you can't do that with. But if the employer gives notice to participants by December 1st of a given year that a 3% contribution may be made in the following year, that satisfies the first part of the requirements. The second part is by 12/1 of the next year, you have to give notice regarding whether the 3% contribution will be made or not. So that gives you 11 months into the year to see, first of all, is it a good year, profitable, and make the contribution. And also, if it turns out that the employer will pass the regular 401k average deferral percentage test, or if the employer just doesn't want to make a contribution for the year because maybe it's not a profitable year, you give the notice by December 1st of the year that the 3% contribution will not be made. Then, of course, at the same time, you tell the employees, by the way, we may make the 3% next year, and we'll let you know next year if we're going to do it. Now, if you do this, it's important for the key employees, that's the owners and certain high-paid officers, to wait to make any deferrals until the decision is made for a given year regarding whether or not the safe harbor contribution will be made. Otherwise, a 3% top-heavy contribution may be needed if the plan is top-heavy. Now, a plan is top-heavy if at least 60% of the benefits are for the owners and certain key employees. Now, this plan design works very well with new comparability, which are also called cross-tested plans, or we call them category plans, because each participant is in a separate category, and you can give a different contribution percent to each participant, subject to certain non-discrimination rules. So let's look at a few examples of how the flexible safe harbor plan can work. In the first example, illustration 1 on slide 15, we have Charles Allen's business. Now, in past years, Charles has had a SEP, an SEP, Simplified Employee Pension Plan, and had been contributing the maximum 20%, so between he and his wife Ann, they were getting about $66,400. Well, the staff cost for the staff employees was 20% also, or about $32,000. And the Allens are only getting 67.5% of the total contribution, which is not all that good. But by implementing a flexible 401k plan, the total contribution for the Allens can be increased, as shown here, to over $71,000, and the contribution of the staff would be reduced to 5%, or about $8,600. Now, it's 5% for most of the employees. One of the employees, Sue Mayfair, actually has to get 8.2% because that's needed to pass some of the very technical non-discrimination tests. So now the Allens get over 89% of the total. Now, as an aside, depending on the type and amount of work that Ann performs, their attorney or CPA might recommend that Ann's salary be reduced to, say, $22,000. This would reduce payroll taxes by up to $8,000, but Ann's total contribution to the 401k plan would only go down by $3,000. Now, one other point here, if the staff, I've shown the staff as making some 401k deferrals here, but if the staff didn't make any deferrals, then we could add a matching contribution, which would only be made to the Allens if they're the only one making deferrals, and the staff contribution could be reduced even more. Now let's look at illustration 2 on slide 16. Many times you'll have an owner who wants to contribute the maximum, but their pay may be well less than the $250,000 that's allowable. And the lower the pay, usually the higher the contribution you have to make for the employees to pass the non-discrimination test. Well, in this case, Mary Johnson makes $130,000 a year. Her son Ron is the office manager and makes $70,000. Now Ron is highly compensated because of attribution. So in testing, he has to be treated as a highly compensated employee. Now Mary can get the total amount of $55,500 this year. Now one thing on these illustrations, they show the results for 2012 since we're still in 2012. Next year it'll be slightly higher on all these. But Mary gets the total $55,500. Now her profit sharing contribution is $33,000 or 25.4% of her compensation. Tom's is 7.5% of pay. Now the employee contribution needed to pass the test, even though Mary gets 25.4%, the staff only need to get 5% of compensation. And in fact, one of the employees, Ann Mitchell, who is a high-paid technician, because this year she made $121,000, last year she made $120,000, so she's highly compensated. She only has to get 3% contribution. That's the top-heavy minimum. And if Mary wanted, she can contribute more than 3% for Ann, but she wouldn't have to. So in this illustration, the Johnsons get 85% of the total. The one thing to look here, as we talked about before, to a certain extent, if you wanted to, you can exclude certain employees from a plan as long as certain coverage tests are met and as long as it doesn't cause human relations problems, because it could do that. Now, excluding highly compensated employees from a plan actually helps the non-discrimination test. For example, if it didn't cause an HR problem, Ann Mitchell could be totally excluded from the plan, and that would reduce the required employer contribution by $3,600. Now, one other thing to note is that if a non-highly compensated employee in this example terminates employment during the year, they still have to get the full 5% contribution due to the safe harbor and some gateway non-discrimination rules. However, if we set the plan up properly, like we talked about before, Ann Mitchell's highly compensated, and if she were included in the plan but terminated, she would get no contribution at all for the year. Oftentimes you have two owners of different ages, as shown in illustration 3 on slide 17. We've got Art Jones and Bill Smith. They're both at least age 50, and they both want to get $55,500. And they can do that, and by having a regular 401k, if they just had the plain vanilla 401k, the staff cost would be 13.9% of pay, or over $51,000. However, by having the flexible allocation formula, the owner's contribution still stays the $55,500 maximum, but the staff cost can be reduced to 5% of compensation, or about $18,500, a savings of over $32,000. Now, this plan design would work well even if Bill Smith were only age 40, for example. Now, he couldn't get the catch-up, so his maximum would be $50,000, but the staff cost would remain at 5% for most of the employees, but for a couple of employees to pass the non-discrimination test, we'd have to give an extra % or two to them, but it'd still be very, very cost-effective. But what if a business, consistently generates a large income, and the owner wants to contribute more than the $50,000 allowed in a 401k plan? Well, if an owner is at least age 30, a defined benefit plan can be considered. For example, illustration 4 shows that a cash balance plan, which is a special type of defined benefit plan, Alan Davis can get a total contribution of $103,500, and the staff cost would be a little over $19,400. So Alan gets 84% of the total in this plan, which is pretty good, but it could be even better if Alan adopted a second plan, if he had both a flexible 401k plan and a cash balance plan, then he can get a total contribution of up to $133,000, and the staff cost would be a little over $12,000. So Alan's contribution increased by over $29,000, and the staff contribution actually decreased by over $7,000. Now, this apparent anomaly is because contributions to the cash balance plan are credited with a relatively low interest rate of 4 to 5%. So for non-discrimination purposes, they are not as valuable as contributions to the 401k plan, because in the 401k plan, the investment earnings are not limited. And under the non-discrimination rules, you can assume that they earn 8.5% regardless of what they actually earn. Now, if an owner is older than Alan in this case, when a plan is first set up, the contribution can be substantially higher. For example, the maximum total contribution for an owner age 55 is over $200,000. Now, let's talk about, in the few minutes we have left, let's talk about some problems to be aware of. You know, IRS recently audited over 100 401k plans that had less than 10 participants that had over $100,000 in loans. And loans in a plan are one of the things that something's going to be done wrong or incorrectly, it'll be in connection with the loans. And as you might guess, you know, over 90% of the plans had problems. So that means IRS is now going to be auditing even more small plans with loans. And of course, when they audit the plan, they don't look at just the loans. They look at other potential problems to see if the employer made any errors. So if a plan has loans, it's a small plan. It's, you know, unless the loans are a small amount, it's likely to be audited. Another thing that has come up recently is on underfunded defined benefit plans that terminate. Well, if a plan is subject to the Pension Benefit Guarantee Corporation, and that would happen if it was not a professional corporation or if it was a professional corporation with over 25 participants. But if it's subject to PBGC and it terminates when it's underfunded, unless the company is bankrupt, the employer must completely fund the benefits, or substantial owners must elect to forego their benefits to the extent needed. In other words, everybody gets paid before the substantial owners. Well, substantial owners defined as owning at least 50% of the business. So if you had a partnership with 5 equal owners, or a corporation with 5 equal owners, you wouldn't have a substantial owner, so they would have to fully fund the contribution. But let's say the plan is not subject to PBGC. It's a professional corporation with 25 or fewer participants. Then if a plan terminates, the benefits are only paid to the extent funded. For example, let's say that the accrued benefits under the plan were $100 million. And the assets at the beginning of the year were $950,000, and it was hoped that by the end of the year it would be up to $1 million. But because of a market correction, when the plan terminated, the assets were only $800,000. Well, if it's not subject to PBGC, then everybody would get 80% of their total accrued benefit, and they could terminate the plan. However, some IRS field agents have told employers that they have to totally fund the plan. Where they got that, I don't know. They sort of pulled it out of the air, I guess. But the national office has confirmed that these agents are incorrect, because whatever the minimum funding required amount determined by the plan's actuary, that's what has to be paid. They don't have to fully fund it. Now, there still may be a required contribution in the year of termination, but it could be a lot less than the amount of the underfunding. Another problem that has arisen very recently, and it came up after the 2011 Form 5500 deadline. The extended deadline was October 15th of this year. Well, IRS has sent notices to a lot of employers saying their 5500 was filed late, even though they had timely filed Form 5558, which extended the deadline for the normal deadline of July 31st to the October 15th extended deadline. Well, it turns out that evidently IRS has a glitch in their system, because the American Society of Pension Professionals and Actuaries is delving into this, and what they say is until the IRS fixes the glitch, if your client receives such a notice, they need to have their third-party administrator contact IRS as soon as possible to make sure to get it resolved. Now, if the IRS thinks the plan was filed late, they send a Form 403 to the employer. And it may or may not have been filed late, but the Form 403 says, you know, let us know if you did file it, and if you didn't file it, why not? Well, it's important to send a response to the IRS within 30 days of receiving the Form 403. Now, let's say the 5500 truly was filed late. Well, then the employer needs to quickly file the 5500 using the Department of Labor late filing program, because that can reduce the fee to just for a small plan to just $750 of penalty tax, which avoids potential late filing penalties of up to $1,100 a day, which would bankrupt most small employers. So the key thing to do this is do it before the Department of Labor notifies you that the plan is late. The IRS late notice does not trigger the automatic imposition of the higher penalty, so it's important to go through this program as soon as possible. Now, one unfortunate thing is that the filing of the 5500 EZ, which is the plan for plans that cover only the owner and or spouse, we don't have a late filing program currently, although they're working on one, and some of the proposals would add that. But I guess the good part is the penalties are only from the IRS, and it's only $25 a day, which still can add up to quite a bit. But hopefully they'll come out with a late filing program for the 5500 EZ. And then finally, we'll talk about determination of controlled groups. If one person owns more than 80% of two or more businesses, those businesses are treated as a controlled group for purposes of retirement plans and for certain tax purposes. And that means that when you do the non-discrimination test, you have to look at all the employees of all these entities to see if they're not discriminatory. Doesn't mean you necessarily have to cover all the employees, but you have to at least take them into account in doing the testing. Now, if a husband and wife have totally separate businesses and they aren't employees of each other's business and they don't run each other's businesses, they're totally separate, then accepting community property states where both of them are deemed as owning the business, the two businesses would not be part of a controlled group if they don't have any minor children. If they have a minor child, however, the two businesses are treated as a controlled group because under attribution rules, the minor child is treated as owning 100% of each company, and therefore you have one person, the minor child, who owns 100% of the two companies, and they're a controlled group and have to be, all the employees of both have to be taken into account. Now, as long as that child is under age 21, the two businesses remain a controlled group even if the husband and wife get divorced. And actually, it occurs even if they aren't married, because the kid is still the child of both of the two parties. So now this is one of the things that's probably most overlooked, and I haven't even seen an IRS audit agent raise it at any audits. But from a technical standpoint, it's a stupid rule, and I wish there were a way to get it changed, but I don't think that's on the horizon. Now, that concludes all the things we're going to talk about today, unless there's any final questions you have. If you do have any final questions, you can go to the dialog box and click type it in and then send privately. Or if you want, after the webinar, you can email additional questions to either myself or to Alan. So, Alan, are there any more questions?
Jim, what are the primary rush requests you're getting before the year end that people need to accomplish in order to have a plan ready for next year, a better plan for next year?
Well, one of the rush requests is if you have the wrong type of safe harbor plan, the combination plan where you have both a defined benefit and a flexible 401k works much better if you do not have a match safe harbor but have a 3% safe harbor. Well, the problem is that if you have the match safe harbor, you were supposed to give notice by December 1st, which was last Saturday, to the employees of what the safe harbor contribution would be for next year. Now, it's sort of unclear, but it's possible, and you should check with an ERISA attorney, it's possible that if you make a change in the plan between now and the end of the year for next year and change it to a 3% safe harbor, then it might still be possible to have the two-plan combination next year. Now, you could still have the two plans next year, but you may want to have the employer, the owner, not make any deferrals, because when you have two plans, there are certain combined plan limitations that can cause problems with passing the non-discrimination test. So that's one of the things. You know, if somebody doesn't have any plan at all, and they don't have a simple IRA, and if they have a SEP, they haven't funded it for the year, then they could still set up a plan in 2012. They could, even though they can't be a safe harbor plan in 2012, because safe harbor plans, new safe harbor plans, have to be set up by October 1st, they could still set up both a 401k plan and a defined benefit plan if they wanted to get more than the $50,000, and they can still keep the staff cost to almost as low as with a regular safe harbor plan. But that needs to be done and signed as soon as possible.
Okay, well, Jim, I want to thank you because over the years you've made me look like such a hero. All I have to do is ask a client to fill out a census form and then send that census form to you with their present plan. And most of the time you make me into a hero by providing that client with a better plan idea. And I really appreciate it. It's a very valuable service you provide.
Well,
all right, well, we certainly appreciate everyone's participation in today's webinar. I wanted to point out for those of you still with us that at 5 o'clock today, at 5:30 today, we're going to have another interesting webinar with healthcare lawyer Lester Perling about what physicians and advisors need to know about excluded persons for the Medicare rules. And also on Wednesday, December 5th, the whistleblower threat. Do you have it and what can you do about it? That's going to be near and dear to the hearts of many physicians and medical practice advisors. Jim, thanks again. I've got your information here that we'll leave on screen a couple of minutes. And again, everybody have a great afternoon.